Number two, we're moving on to PPI. Gary, the PPI comes in hot. Thing number two on this week's version.
All right. The PPI stands for Producer Price Index. It is different from the CPI. It's similar, but it measures price changes experienced by manufacturers and suppliers of goods and services. So a way to think about this is the PPI is the precursor to the CPI. If your manufacturers start to see price increases for the raw materials they use or for the components they use, you're going to see higher prices a couple of months down the road. If their prices come down, if the PPI prices come down, the producer prices come down, then we'll see a lower CPI. So the PPI is a good way to predict the CPI down the road, through the sales cycle a couple of months down the road. This, unlike the CPI, which came in below expectations, came in really hot. The annual PPI last month was up 2.6%. That was well above the expected 2.3%. For people who don't follow this all the time, usually when the predictors, when the economists are wrong, they're off by maybe 0.1%. Given the complexity of these issues, that's actually not bad, right? Like if you can predict these things to within 0.1%, as an economist, you're doing a pretty good job. This was a situation where the miss in this case was 0.3. That's about triple a normal miss. That's a big number. The core PPI was even a bigger change. So the core excludes food and energy. That was up 3%. That was way above expectations of 2.5% and above last month's 2.3%. These are huge, huge misses by the analyst community. This is an indicator that what Mark was saying just a few minutes ago is likely to be right. When you see the PPI rising this much in this short a time, it would not be a surprise for Mark to be right and for the CPI to rise. Mark, the question I want to ask you, I would love for you to give the explanation that we talked about before on the monthly numbers, because it looked, when you looked at the core number, people were expecting a monthly core increase of 0%, and the reported number was just a little bit above that. And your point is not even close. You've got this with a huge increase. I would love for you to explain to people how you're coming to your numbers, because I agree with your analysis, but I don't think a lot of people are focused on it.
So one of the big things that happens when the data comes out, because a lot of these are surveys, so you're usually not sure, you're trying to estimate, you're trying to use statistics to close the gap. But because the surveys are getting less and less consistent, you're seeing a lot of revisions. And one of the biggest things that we saw is a huge revision up. So when you look at core PPI, for an example, last month was revised from 0% to 0.3%. So when you have that 0.4 that happened this past month, you're actually increasing off the revised number. So you're seeing this big pivot up and this big revision, which typically PPI is about, let's call it anywhere from 4 to 8 weeks in advance of what you're going to see coming down the pipe. And that's where, when you see a lot of the differentiating problems, especially when you look at core, and then you look down into the different transportation services and the other underlying components that are showing that things are starting to accelerate once again. One of the other key components that we look at is final demand. And PPI final demand is, what is the final product? Like as Gary was talking about, there's different pieces, there's freight, there's all these different components. But when you look at what is the cost of that final product, and you actually had a really big acceleration, which is showing that that's going to show up at the consumer level, because that's what I'm buying. You're seeing that get passed through as much as possible. And these are those increases where not only is the revisions going up, so the increase was much bigger than initially expected, but also that final demand is showing that it's really going to show up very quickly, which is why we do think it's going to be that increase next month.
So the increase that you had calculated, once you include, this is on the core number, the adjustment for the prior month, it really looks like the increase for this month, including the prior month revision, was 0.7% above expectations. Now, for people who think, okay, wait, is that a big deal? If I'm paying $100 for something, is paying, $100.70, is that a big deal? And yes, and here's why, because it's in 1 month. If you annualize that, you come to a number just under 9%. And so, listen, does the PPI up that much in 1 month mean we're going to have 9% inflation again next month? No, absolutely not. But it is not a good sign. And, you know, again, after the CPI came out, the market thought the probability of a September rate cut was about 80%. You know, Powell looks at this. I think when he saw that, he had to think, yeah, we're going to have to hold off. This really, that puts a hammer in the higher for longer thesis that we've had forever. And, you know, I know we keep coming back to it, but this is now over 2 years that all of these market observers and market participants have been saying the Fed's going to pivot, the Fed's going to pivot. 2 years later, they've been wrong. The bond market, supposedly the smart money, they've been wrong for 2 years. We've been sitting here saying higher for longer for 2 years. And this is where we are. And I think that's going to continue for a while.
Yeah, and I think the biggest point as well, because to your comment about, well, where's it going to show up? You know, as a business owner, you're like, okay, well, can I pass it down, or do I have to eat some of my margin? Because you're looking at that pricing, you're like, all right, well, let me take and feel out what is happening at the consumer level. Are, you know, where's savings? Where's excess savings? You know, where's credit card debt? And if you go down that list, you're like, ooh, you know, consumer savings is pretty much gone. You know, you have credit card interest rates on average at 24%, at the maximum 28%, a compounding pressure point, and you have credit card debt at record highs. So it's like, okay, well, how much of that can I push down? And so far, they continue to see the ability to pass some of that through. But when you see that stop, that's when you start to get those big earnings revisions. That's when you start to see that show up in the corporate data, and you're starting to see some people waffling on what that second half is going to look like, because it's going to be a matter of how much longer can the consumer eat the pain.
For all of you out there, say it with us again. Higher for longer here at Deep Knowledge Investing. Gary's taking the under on the 80% as well. So mark that one down.